This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. This is the yet another lecture on Chapter 18 of the paper P4 course notes on foreign exchange risk management, and it's the third and final lecture on futures. In the last lecture, I finished by suggesting that you had a go at example 11, which was a full example putting together everything we've done so far. And so what I'm going to do in this last lecture is go through example 11, so you can check yourself with me, and then make a couple of final points relating to futures. So first of all, let's go through example 11, which is on page... which one is it? Page 106. Have a quick read with me and then we'll set it up. It's the 20th of June 2004, so that's today. We owe an American supplier $500,000 payable on the 12th of September. We know today's spot rate, but of course we're going to leave the transaction at risk and we're going to deal in futures. And it tells us the futures price is today, 20th of June. There's that little table there. There are 3 futures available. Well, we're going to do exactly what we did before. Let's work through it step by step. First of all, something I always do, but I've said several times isn't always actually needed, but I'll work out what I keep calling a reference point. And all I mean by that is let's convert at the current spot rate. Obviously, we're not actually going to convert at today's spot at all. This is just something we can refer back to later if we're discussing how good a hedge it's been and so on. So at current spot, we're paying money, remember? Excuse me. We're paying $500,000. Today's spot rate 1.4821 to 1.4896. Well, here, because we're paying dollars, we're buying dollars, we'll convert at the dollar buy rate 1.4821. And so at today's rate, it would cost us $337,359. It would be a payment. Well, that's just to check back to, but let's now write down what in fact we're going to do today. Today is the 20th of June. First of all, do remember we're going to leave the transaction at risk. We'll convert at whatever spot happens to be on the date of the transaction, the 12th of September. To hedge against that risk, we're going to start a futures deal. So let's set up what the deal is going to be. First of all, we need a month. Which futures are we going to deal in? We've got a choice here. There are June futures, September futures, December futures. Well, remember the rule. We've got to choose one that ends after the date of the transaction. Transaction's 12th of September, so a June future's no good. That must finish by the end of June. You could go for either September or December, but for the exam, go for the first one after the date of the deal. So we're going to choose September futures. We can stop at any time up to the end of September. And the price of them today is 1.4840. And from now on, the other 2 futures are irrelevant. It's the September ones we're dealing in. I also need to know, am I going to buy futures today and sell later, or am I going to sell futures today and buy later? Well, I said before, there are 2 ways you can look at it. Whichever you find more obvious, and faster. In a sense, the logical way is to say, what am I worried about? I'm paying money. Today's rate is 1.4821. Clearly the rate will change by September, the date of the transaction. But if I'm paying money, surely what I'm worried about is the rate falling. Because if the exchange rate falls, we'll end up having to pay more pounds. And so I need to be able to make a profit from futures if the rate falls. Well, how can I make a profit if the rate falls? The way I'd make a profit is by selling futures today at today's price. And if the rate falls, I then buy them later at the lower rate. And if I'm buying at a lower rate, well, that's how I make my profit. Or the other way is to say, what's the transaction in the contract currency? The contract currency you'd always be given it. It's the bit at the top of the futures table. The contract's at £62,500. We then say, what's the transaction in the contract currency? Well, the transaction itself, because we're having to pay dollars, we'll need to buy dollars. And to buy dollars means selling pounds. The contract currency. And because it means selling pounds, we'll sell futures. The final thing we need to know is how many contracts. Well, you take the transaction amount, 500,000. That's the amount we would like to deal in. We've got to restate it in pounds. Well, convert at the current futures price, 1.4840, and that's how many pounds we want to deal in. It has to be in fixed size contracts, so divide by the contract size of 62,500. So what does that come to? 500,000 divided by 1.4840. Sorry, I think I keep having calculator problems here. 500,000 divided by 1.4840. In pounds we want 336,927, but divide by 62,500. I get 5.39. For the exam, go to the nearest number. We'll deal in 5 contracts. And so the futures deal will sell 5 September contracts at 1.4840. And so that's all that happens today. Transaction, we've done nothing at all. We just ring the dealer, announce that we want to sell 5 September contracts, and that's all. All right, we'll have to pay a deposit. We call it the margin. The deposit we'll get back. For the numbers in the exam, we ignore that, but otherwise it's simply recorded as sell. We'll have to buy back later, but later we'll work out any profit or loss and settle up. So that's all we've done today. We then wait until the date of transaction. Which is the 12th of September. And remember, on the 12th of September, we'll convert the transaction, we'll convert the dollars at whatever spot happens to be, and on the same day, we'll finish our futures deal. If you wanted to illustrate, then of course we need to know what is the spot rate, what is the futures price. These are September futures, remember. Well, the spot rate we've been given. It's 1.4791 to 1.4812. The problem, though, this time is we're not given the September futures price. If you are, you use this figure clearly. We're not given it, we're going to need it. And so we'll have to estimate it as we did in example 10. So let's estimate what that futures price is going to be. And I'll do it as a table as I did before. First of all, what's the position today? Today's the 20th of June. The September futures price on the 20th of June is 1.4840. The spot rate on the 20th of June, well, the mid-market price, so 1.4821, 1.4896, the average, I get an average, a mid-market price of 1.4859. Keep it to 4 decimal places. And so the difference is 0.0019. I want to estimate the futures price on the date of the transaction, which is the 12th of September. We know the spot rate, so again I'll use the mid-market, 1.4791, 1.4812. The mid-market is 1.4802. But to get the futures price, we're going to have to estimate the difference and then go from one to the other. And remember, we assume that at the end of the future, here the September futures again, so the end of the future is the last day, the 30th of September. On that day, the difference will be 0. And we assume the difference falls linearly to 0 over the period. Well, I did say before, if you've got other than beginning, end of month, then really it's a question of counting days. So at the moment, how many days are there to go? Well, 20th of June, 30 days. There are 30 days in June, so there's 10 days left in June. August, there are 31 days. September, there are 30. So the total is, oh sorry, I missed out July, I am sorry. There's 10 days left in June. July has how many days? 30 September, 31. August has 31. September has 30. So I get 102 days. I'm not worried about 1 or 2 days, it'll make no difference, but 102 days. By 12th of September, well, from the 12th to the 30th, there's only, what, 18 days. And so the difference will have fallen. If it's falling linearly, it'll be a fraction, 18 divided by 102 times 0.0019, which comes to 0.0003. Well, the futures price was below the spot rate by 19. Now it's down by only 3, which gives us an estimate of futures price of $1.4799. And so there we are. Remember, we need to know on the date of the transaction, we need to know the spot rate which we were given. We need the futures price. We now know it's 1.4799. And now we're in a position to actually sort out what happens on the 12th of September. So on the 12th of September, first of all, the transaction, we convert at spot. The transaction was $500,000. We're paying, so remember, we're having to buy dollars, it's the buy rate, which was 1.4791. The transaction itself will cost us $338,043. Remember, this time we're paying money, so we'll have to pay that much. And perhaps I'm wasting time, but if you compare with our reference point, at today's spot we'd be paying $337,000. The spot moved against us. Here we're having to pay $338,000. In that sense, we're losing money. However, on the same day we'll finish our futures deal, and we've got our profit or loss on futures. And to get the profit or loss, you take the number of contracts. It was 5 contracts. Each contract was of 62,500. So that's the total we're dealing in. And to get the profit or loss on each pound, we take the sell price minus the buy price. Now this time, remember, we started the deal by selling on the 20th of June. And on the 20th of June, we were selling at a price of 1.4840. To finish the deal, we buy the futures on the 12th of September. And on the 12th of September, it's 1.4799. And so, what's our profit? The difference, 1.4840 minus 1.4799, it's a profit of $0.0041 on every pound, multiplied by 62,500 times 5 contracts. It's 120, sorry, I beg your pardon. It's 1281.25. And that profit is in dollars. We were trading on the dollar value of the pound. Finally, though, that is a profit, so we're going to receive that many dollars, but we need to convert to pounds. We receive it on the 12th of September, and so we'll use the September spot. And since we're receiving dollars, we'd be selling dollars. The price is 1.489. No, it isn't. Sorry. The September spot rate, which is 1.4812. And so the receipt, $1,281.25, converted at 1.4812, £865 a receipt. And so, as always, although it is 2 separate deals, the net result, you're paying out 338,043, you're receiving 865. There's a net payment of 337,178. And there we are. 2 little things before I leave this example. One is, I don't know if it's occurred to any of you, but you could have been quite clever. A way you could have ended up reducing the payment slightly is, instead of converting those dollars and having to use the dollar sell rate, you could have used those dollars to pay some of the $500,000 we were owing, and only have converted the balance at 1.4791. Now, I'm not going to do that, and you really wouldn't be expected to. It might give you a bonus mark. But certainly, if you had spotted that, even if you didn't do the arithmetic, it would have been worth writing a little note that try it if you don't believe me. But if you'd taken the 1281, used it to pay some of that, and only converted what was left, you would in fact have ended up having to pay slightly less. You'd have gained a few pounds. Secondly, although I'm not going to work out the hedging efficiency, well, yes, I'm not, it won't take a moment. In a second I'll work out hedging efficiency, but is it a perfect hedge? At today's rate, we'd have paid 337,359. We end up paying 337,178. Well, it's not perfect, but here, in fact, we've made a little bit of a gain, have we not? Let's just work out the efficiency. I gave you the formula earlier. It's the profit on one deal divided by the loss on the other. As a percentage. Well, here again, it was the futures made the profit. We made a profit of 865. It was the transaction itself we lost money, because we ended up having to pay 338043, whereas at today's rate we'd have only have been paying 337,359. And so we've had to pay more. In that sense, we've made a loss. 338043 minus 337,359. 684. And so we lost 684, but we gained 865. The efficiency is 126%. And I did say earlier, if the efficiency is more than 100%, it means you've made a net gain, which we have. The net result, a payment of 337,178 as against 337,359, we have gained a little bit. So no problem. Okay, well that's almost it. But I just want to make a few final points. The first is really a terminology thing. I've said several times the reason you won't expect a perfect hedge is partly because of contract size, that we weren't able to deal in the exact amount, but more importantly, the fact that the change, the movement in the spot rate is not the same as the movement in the futures price. Well, that difference here is called the basis risk. And in fact, different people refer to it differently, slightly differently. It doesn't matter for the exam. Some people refer to the difference itself as being the basis risk. Other people refer to the basis risk as being the difference in the movement. But the point is, that's the problem we've been talking about. Just one thing which is quite interesting, but I'm not going to do more numbers on this, is that, think about this carefully just for a moment, because it is interesting. Obviously in real life, you start your deal on the 20th of June, and in real life you have no idea what's going to happen to spot. This question told us spot was 1.4802 and we used it to illustrate, but it could have been anything. Spot could have been 1.47, it could have been 1.49, anything you want. But whatever spot turns out to be, the difference between the futures and spot, currently we know for a fact is 19, and our assumption whatever spot turns out to be, the futures will be different by 0.003. That whatever happens, whatever the spot rate is, the futures, obviously, different spot, different futures price, but the difference would be 0.003. And the difference in the movement of the two will be 0.0016. And so although I'm not going to do more arithmetic here, and you wouldn't be expected to do any more, even though on the 20th of June when this started, I didn't know what spot was going to be, I could predict that this basis risk problem, that they won't move in exactly the same way, by exactly the same amount, but the difference in the movement will be 16 points, 0.0016. I could have actually predicted that from the very beginning. Anyway, sorry if that last bit confused, I apologise. I just think it was interesting.